Welcome to the Growth Beyond Limits podcast, a dynamic podcast designed for aspiring entrepreneurs and early stage business owners aiming to reach their first million. Each episode features high impact conversations with business leaders, innovators, and personal development experts who share actionable insights to fuel both professional and personal growth. Growth beyond limits. Go where you need to be. Hey, welcome back to the show, Growth Beyond Limits podcast, where we give you real strategies, real stories, and real results. And today's episode, we are going to be talking about money matters, accounting and taxes for entrepreneurs. And when I thought about this show, only one person really came to mind that I have in my wheelhouse. It's a good friend of mine, a guy that I highly respect, who's in the industry of helping people understand how money works and how you keep yourself out of trouble with the government. I have today with us John Paul, who is the CEO of ICFO Consulting, and he's also the CFO for the Southern District of the Nazarene Churches. And he is one of the most knowledgeable people when it comes down to economics. What I like about John is how he breaks it down into layman's terms, and he makes it reachable. He puts the cookie down on the bottom shelf so you can grab it, because finances are so complex. So we want to welcome John Paul to the show. John, go ahead and introduce yourself to our audience. Tell us about who this great man is. I mean, dapper looking.
Oh, man. Trying to be like you. Anyhow, man, thanks for the invite here, and it's an honor to be here and with this podcast. So I'm John Paul. I'm the, as you said, CFO of Southern Florida District Church of Nazarene that has over 120 churches in the Southern Florida, 17 counties in Southern Florida. So that's that. But, overall, I'm a servant of God. So everything I do is in service.
Okay.
So including finance. So also call me Minister of Finance.
Yeah. So our audience reaches beyond just the walls of the church.
Yeah.
We talk about business because business affects those who are in the sacred space and those who are in the marketplace. Because here's what I believe: running the business isn't just about making money. It's about managing it wisely and staying on the right side of taxes. So today we're talking about the financial backbone of entrepreneurship, which is accounting. A lot of times people think, I just have a business idea, I'm going to go ahead and create a logo, get me a social media page, but they don't think about accounting and taxes. So whether you're just starting out or you're trying to scale, understanding these fundamentals can make or break your business. So let's jump right into it, John.
Let's do it.
Let's get to the basics. So for someone starting a business, what are the most important accounting habits they should build from day one?
From day one, one of the things I always preach is you got to pay yourself. All right. So if you're looking at that as an accounting thing, that's a thing. But number one, I think business owners often sacrifice everything and don't think about how to pay themselves. All right. So, and I understand sometimes it takes a while to get to the salary that you want from your own business.
Right.
But somewhere in there, you got to figure out how to compensate yourself. All right. If the business that you in can't bring in enough money to pay yourself, then you've got to wonder, is it the right business for me?
Wow. So from the jump.
Well, again, I think it's an important thing to understand.
Right.
Right. So if we back that up a little bit, it goes back to then, my basic concept of business. All right, Milton Friedman, the great economist, he said, the business of business is business. All right.
Say it again.
Yeah. The business of business is business. All right. I simplify and I just say the business of business is to make money.
Right.
All right. If you're in a business that does not make money, then we're in some kind of, I won't even call it nonprofit.
You're in a hobby.
It says nonprofit, you're in a hobby. All right. And if it's okay if you want to fund your own hobby, that's fine. It's not a big deal because we all got to have something to do, but just don't call it a business.
Okay.
Right? So
if you can't pay yourself and you're not making money, okay. Now the common myth is that it takes 3 to 5 years before you can start paying yourself. So bust that myth real quick.
I think that myth is a thing that people use as a crutch to continue to lose money.
Wow.
All right, let that sink in for a second. That's kind of heavy, right?
Right.
I think sometimes Small business owners use it as a crutch to continue to lose money. Like it's like, it's okay. The business is supposed to lose money in the first 2 to 3 years. And yes, there's a part of that. I'd say this. If the single thing that you sell or the service that you provide does not make money in itself, then there's no point to be in that. Now, what I'm saying essentially, if you sell food, for example, and selling food by itself doesn't make money, then you got to rethink what you're doing. Now, I understand in the first couple of years, this is what really happens, right? You factor in rent, you factor in overhead,
Right.
you factor in paying yourself, you factor in marketing and things that are needed to get the business off the ground, right? So those things, yeah, you do that. But once you do that and you gotten the business off the ground, you should be stabilizing to a point that you're good. But also in pricing, this is a thing, we can get into pricing, which is a different thing. But in pricing your service or the product, we oftentimes shoot ourselves in the foot by undercutting, right?
Because we want to attract customers. We lowball ourselves.
We lowball ourselves. Meanwhile, it's not making money. And then so we lowball from the beginning, and then we come back to say, all right, now we're gonna raise the price. Well, you've already trained your customers to the low price.
Wow.
Right?
Whew, man. And that's just the first question. And you're hitting us.
Hey, listen, if you're not in business to make money, then you just have a hobby. And it's okay to have a hobby, but you just have to understand that, all right, I have a hobby. And when then you won't be so frustrated putting money into the business.
Okay, so
continuously.
You're funding the hobby.
You're funding a hobby. It is good to have a hobby. You're having fun.
That's an expensive hobby, man. You spending 12 hours working and you can't pay yourself. I know some entrepreneurs right now that's saying, okay, man, I'm not making any money. I pay my employees, I pay all my expenses, and I can't pay myself.
It's tough. I'll tell you what, I know entrepreneurs who put their own, every time they have in, every dollar they have in, they've cashed in their 401ks in order to pay to make sure the employee is paid.
Wow.
Meanwhile, we're going out of business.
Wow.
At some point. All right.
That is crazy.
It's tough, but it's one of those you just have to. It's good to go into business, but somewhere in there, the numbers don't lie. Numbers have a way to bring a sombering clarity to you.
Right.
That says, hey, this isn't making money. At that point, you got a decision to make.
Yeah. Do I keep throwing money at this thing?
You got to keep throwing. Maybe your pricing is maybe wrong, right? Maybe you're just not pricing right.
Or your business structure is not.
Your business structure is not wrong. Maybe you thought this, you sometimes we follow a trend. We're like, so all these businesses are coming out. We're just going to follow it. Well, maybe it's good. Other people who are making money in it are good, but you're not able to put it in a way to make money.
Or it's not designed for you. All right. So let's talk real quickly about separating personal and business finances.
Yeah, that's a big.
Why is it so critical to keep personal and business finances separate? And what problems can happen if you don't?
All right. Yep. So if you keep personal and business, and we're talking about operating, you have a separate entity, an LLC, a corporation, or something that you're operating, and you keep, both are together. Or the legal side of that. What happens, the reason why you create a limited liability company, LLC, right?
Yeah.
Is so you can limit your own liability, right? Limit your
That's
own
the whole
liability.
idea of limited liability, right?
It's in the name, okay?
Okay.
It's in the name. So we're limiting liability. And now, but limiting liability means you got to follow the rules of business and how things work. If now we're crossing the line, you can't tell what's business and personal within the LLC, then from a legal standpoint, it's what's called piercing the corporate veil, which essentially says, hey, well, since you already I can't tell what's business versus personal here. Well, when it comes time for somebody to sue you, they can't tell what's business and personal. So now the limited liability you had personally is gone.
Right.
And that's the biggest thing, I think, is to do that. But that's a lot. First, there's a liability part of that. All right, and then the second part, there's some tax reasons why you would want to have different types of entity, depending on the kind of company you have, depending on the profits you're trying to make, and all those types of things.
So John, you kind of tapped something I want to piggyback on here.
Yeah.
what's the difference between an LLC, a corporation, or a sole proprietorship?
Yeah.
Walk us through that real quickly in layman's term. Because
All right,
people go,
so
I have my own LLC. I incorporated my business. So
yeah. So, and sole proprietorship is something you file on your own personal tax return. Essentially means it's not incorporated. It doesn't
Okay.
have a separate tax ID.
okay,
And it's just, you just start off a business on your own. It's using your name. And so that's that. All right. It's simple. It's the quickest way to get up and running. The problem is if something happens and let's say you had a rental property, for example, it was on your own name and something happened at that rental property and somebody broke a leg or God forbid passed away, well, you have liability exposure, right?
right.
Personally. All right. So that's why you see a lot of rental properties or real estate is in an LLC, right? So the LLC is limited liability corporation, limits liability, right?
That's in the name.
It's in the name,
Right.
all right? Versus and then a corporation is just it's a corporation, and so those are taxed differently as well. So those three are really, that's the difference between those three. Which one is more advantageous depends on what your goal is and what you're trying to do and the income and projections and everything like that. So it's not a one size fit all everything. I think everybody just defaults to LLC, LLC, LLC.
Right.
That's what we know.
It's the cute thing.
I
started my own LLC.
Man, I'm going to open up my LLC.
Yeah.
But what does that mean?
Right.
All right, I got an LLC. I need to do an LLC tax. By the way, there is not an LLC tax. Okay, corporations are taxed at a corporate level. LLCs, you can file a tax on your personal return with them, or you can file a separate corporation return, or depending if there's two owners in there, it could be a partnership. So,
right.
Those are different ways you can file.
So if a
an
business
LLC.
owner, let's say they're starting their business and they put their own money into the business,
Right.
how should that be accounted for? Let's say the first $25,000 or $30,000 comes from their 401k or their savings account, the money they had under their mattress or whatever. How should they register that?
The accounting term is owner's capital, owner's contribution,
Okay.
or some kind of variation of that wording, right? Essentially, this is it's the equity that the owner is putting in,
Right.
all right? It's the skin in the game that the owner has that they're putting in.
Is it documented where they can get paid back? Let's say 2 years down the road, they need to write themselves a check back.
Well, that's the part, right? When you start an LLC, if it's your own LLC, if the two of us decide to go into business, we start an LLC. One of the other thing that goes with the LLC is what's called an operating agreement, right?
Right.
That spells out all the different terms. What happens if what happens, down the road if we start at what point do we start making distributions back to the owner? At what point do we start repaying the owner? Sometimes the contribution that the owner makes could be classified as a loan.
Right.
Right. We can call it a loan as well if that's what they want. But generally, it's owner's contribution is what it's called.
Okay.
Yep.
Okay. So let's talk about understanding taxes.
Yeah.
What are the biggest tax obligations entrepreneurs tend to overlook or misunderstand early on?
Yeah, the biggest there's two of those, and it depends on the type of business you have. If you have a business where you're selling a product, the tax liability that's overlooked is the one that we all pay every day. Sales tax. Okay, and I'll tell you what, the Florida Department of Revenue does not play. They are quicker to get to you than the IRS will. All right, so that's Florida Department of Revenue. So sales tax number one. All right. And then if you have employees, then it's payroll taxes.
Right.
All right. So those are the two main taxes.
Your 941.
941, that's part of the payroll taxes.
Okay.
So those are the two taxes the business is going to pay. If you have income, net income, that means you've made a profit, then you may have self-employment taxes depending on how your business is structured. And then you're ultimately going to have income tax that you will pay on the income. All right.
Okay. So I hear you say two things: pay yourself and pay the government.
Pay yourself. Uncle Sam. All right. So let's talk about Uncle Sam. Uncle Sam is not as bad of an uncle as we think.
Really?
Well, let's think about it. Now, there's pay Caesar what's due to Caesar. pay the IRS what's due to the IRS.
Right.
At the end of the day, the secret to being friendly to Uncle Sam is to be compliant. All right. Compliant means when it's due, you pay it. All right. When the filing date has come up, you file it. Right. If you file it on time and you pay when you're supposed to, you'll never have a problem with the IRS.
Right.
Because you've done what you're supposed to do. You're compliant. All right. So, and I think the issue is sometimes what happens is that for lack of knowledge, all right, we failed to do what we're supposed to, not because we didn't want to do it sometimes, just because, we just weren't knowledgeable enough about what the taxes we were supposed to do.
Now, I want to ask you an interesting question. We always hear, especially in the political discourse lately, about how the rich, the wealthy, always find ways to get out of paying taxes. Yeah. And let's talk to that person who's out there, who's a multimillionaire, trending towards being a billionaire. How do they make that happen where they find the loopholes, which is the common term? You can correct me. Yeah. Where they pay the least amount of taxes because they know how to do all the deductions and all this crazy stuff.
Well, the reality of it is, if you look at it, the richest people in the country pay the most taxes. It might be as a percentage of their income, maybe it's less. Okay. Right? But overall, I mean, they pay taxes. So I think there's a part, really the way the tax codes are written, for people who are regular W-2 employees, there's not a lot of things you can do.
Right.
All right. There's not a lot of things you can do to help save on taxes. All right. But for people, that's why, I think Donald Trump is always notorious for getting flack for not paying taxes. Well, he's not doing anything. He's using up a lot of losses that he had in business losses that you can write off things against other gains that you have. Right, so you never have income.
So wealthy people have more things, more provisions that they can access.
And it's not so much as wealthy people. It's business owners. Business
business
owners. So in taxes, there's 3 categories of taxes.
Okay.
Right? So one,
Let me lean in for this one.
Yeah. So one, you have what's called active income.
Okay.
Right? Active income is your W-2. Right. In your W-2, when you look at it, there's a thing called FICA, Social Security tax or Medicare taxes, right? Those 2 things right there.
Active income.
So those you can't escape in active income.
Right.
All right. If you are a self-employed person, you have a Schedule C, there's what's called self-employment tax, right? That's the FICA part, right? So you still are paying that. So you're still active income.
Right.
Right. As long as you're in the active income, you will pay FICA. You will pay the self-employment taxes. There's also what's called portfolio type income, right? Like your interest incomes, your dividends, all right, capital gains, those things. That's portfolio type income. And then you have passive income that you would have from rental properties, or if you were in, a part owner, a silent owner of a business. That's also kind of passive income. All right. So the 2, you have active income where there's self-employment tax.
Okay.
In the portfolio income as well as the passive income, there's no self-employment taxes.
Okay.
So Dr. Phil, if I'd say, hey man, if you're gonna make $1 million, which category would you want to make the $1 million in?
I would definitely want to make it in the passive income.
You got to make it in the passive or
the self,
or the other,
not the active income,
right? So self-employment tax is 15.3%.
Right.
So 15.3%. If you're making income in a passive category where you're not paying 15.3%,
right,
you gain.
Right.
So the game here then, if it's not really a game, is over time, is to not be in the active income. All right, it's to be in the portfolio, or the passive.
Oh, so you want to move? You want to move out of that bracket?
You want to move out of that bracket because there's no self-employment tax in there, and you're in a better shape.
That is key right there.
That's key. Now, there's another part to that that's like, well, people want to play games and not ever have self-employment income. Well, you also don't have access to Social Security benefits, Medicare benefits, and those things, right, could happen.
Because you don't pay into it.
You didn't pay anything into it. So you want to pay some into it because it opens the door for you to have benefits into that, right? To qualify for Medicare, if you were to have a bad disability or something, Medicare could tap in, right? At the very least. So there's some nuance in there.
That's so good. Yeah. So on that same question of taxes, what are some common deductions that business owners miss, and how can they legally reduce their tax burden?
Common deduction business owners miss.
Yeah, common deductions that they miss. Business
home office. Maybe it might be a home office.
A home office. Okay.
Home office deduction. But I think probably the common one is auto mileage reimbursement for mileage that they have for driving to do business stuff. And the reason is that they've not tracked it, right? They didn't keep track of it.
How do you track that? Because I know people say, well, I use my car for business. So what's the proper way to track that if you're going to use it as a deduction?
If you're gonna, this is one of those areas that the IRS, is very picky in. It actually, on the tax return, if you're using mileage, it says, all right, do you have proof of this expense? And is the proof in writing, right? So they want to see, like, all right, today I went from here to this place to do business, and this was the reason I did that, and I drove from here to there, all right? So now that tracks it.
So you have to be almost like a slave to it.
Well, technology helps us a little bit with that, right?
Okay.
There's apps. There's a real good app called Mile IQ.
Mile IQ.
Mile IQ. All right. Okay. I'm not promoting this. I'm getting nothing out of this.
Right.
But
you don't have passive income from it?
No, I don't. I might need to contact them to figure out how I can be an affiliate or something. But Mile IQ is great because it tracks your trips wherever you're going. It tracks your trips,
and the government respects that.
Yeah, government. What it's doing is tracking. It's saying tracking where you're going, and then now you can categorize and say this is business and add the business purpose to it. Wow, and that helps. All right.
So this is so good. I coach entrepreneurs. Yep. I coach business owners as an executive coach, and a lot of times we're not having this conversation during our coaching session because we're doing strategic planning. Yep. We're helping them, come up with the brand guide and getting the website. So at what point should a business owner or newly emerging entrepreneur contact someone like you in their entrepreneurial journey? What is the right time for them to start talking to you?
From the beginning.
Right. So hire an accountant or CFO from the beginning.
All right. So I think you have to start you got to be thinking about that from the beginning.
Habits.
All right. You got to be thinking about it. And you also got to have the numbers. And it depends. Sometimes not everybody needs me. Right. Not everybody needs that. But if you don't have the skill set yourself, right? If you don't have the knowledge yourself, all right, if you're not able to basically do a thing and say, hey, what is this profitable? Does this make me money? All right. If you can't answer that question or you don't know how to figure out math to do that, just to get that answer, then you need somebody to help you to do that. Right. And so sometimes you don't need to bookkeeping early on. You don't necessarily need to hire an accountant, but you definitely need to have somebody to help you set it up so that you can be successful from the beginning. You might be able to do DIY accounting yourself if somebody help you set it up and you understand how to do it. Right. But sometimes you pay, you pinch a penny here and you pay for it later. Right. So it's best to just hire somebody who can help you navigate that and get things set up, get bookkeeping set up, and have the tax strategy set up so that you're able to have success in that.
Can someone like you help someone see if they're building the business to be profitable from day one? Like, their price. So do you kind of like an overview? You have a dashboard to be able to poke holes to see if they're gonna make money?
Yeah, I mean, I think that's part of the strategy, right? It's you have a strategy first, that says this is, as you have the strategy, we got to put numbers in there. Right. We got to put dollars in there to say, does this make sense?
Not ideas.
Does
put it on
this
paper.
make dollars? Right.
Right.
Yep. And if it doesn't make sense, and sometimes as you look at the strategy you have and you put dollars to it, right? Then you come back and say, all right, well, this isn't working as I thought.
Mm-hmm.
All right. So we go back and we do another iteration of the strategy and change up something. All right. Well, we need to change up a little bit here, so we can figure out how to make the profit. Maybe there's a component of cost that's too high, or maybe a lot of times is we're undercutting in terms of pricing.
Yeah.
That's huge.
So I hear people talk about breaking even.
Yeah.
Is that such a term?
Break even. Yeah.
Break even. If I break even, I'm not doing that bad.
If you break even, you're not doing bad because at least you don't. So now we got to define break even.
Right.
Right. So
like break even. Okay. I'm not losing money, but I'm not making money.
Well, we got to. When I say we got to define it, what are all the expenses or costs you're including in the break even analysis?
Yeah.
Right. You might break even like what you spent. This is where I bring in, making sure you're paid, right? Because there's a part here that if I bought materials for $100 and I sold it for $120, then I've made $20 on everything, right?
Mm-hmm.
So to that extent, the basic break even says if I put $100 into it and I can sell it for $100, then I'm break even.
Right.
All right. But if we didn't factor in order for me to sell it for $100, I got to put 3 hours of my own work in there, and that's not factored.
Wow.
Then did I really break even?
Yeah. Yeah.
I've lost money now because my time's got value. Well, what's the value for my time? Wow. Right? At the very least.
So you didn't break even.
At the very least, for someone who works in a other job, right? The value of your time is whatever you're getting paid at the other job.
Right.
Right? If you can't make that in the numbers that you have, then we didn't really break even.
This is so good. This is so good.
So again, that's the part. That's where I think sometimes pricing, even in your break even analysis, you got to make sure you're catching all the costs that's going in there.
So, John, talk to that entrepreneur. Look into that camera and talk to that entrepreneur about some common mistakes that you have seen, and because you've been doing this for over 30 years, if I'm correct,
Close
right?
to it. Yep.
Okay, give us a little window into your experience of horror stories and success stories.
Yeah, I'll say one of the biggest pricing. I think I'm beating a dead horse,
right?
Pricing is definitely one, right? We're undercutting ourselves, all right, and not pricing right from the beginning, all right. And with pricing, I would rather that we if I'm doing a promotion, I would rather show them the full price and show the promotion that is that expires in 2 months or
like for example, let me give you an example. I'm getting ready to give our audience a package of information, right? Mm-hmm. Which is valued at $9.95.
Yep.
But I'm gonna do a blitz. I'm gonna give it for $97.
Right.
For 60 days. So you're saying something like that. It's valued at $9.95.
That's the value.
And by the way, stay tuned. That's coming up very soon.
All right.
So follow us on Instagram, subscribe on YouTube. So when that promotion comes out, you can get those things. So that's what you're talking about.
That's your value, right? That's the value. It's really a $9.95 product, right? But you're getting it at a promotional rate.
Right.
All right. So that is just a promotional rate. That means essentially you're calling that marketing.
Right.
What they're not paying is a cost to you.
Yes.
You eating that cost.
Yes.
All right. So pricing is number one, is just getting that right. Number two, I think, is understanding that that in addition to pricing overall, you really have to understand the basics of whether or not the product that you're selling makes money. All right, the service that you're doing, does that make money?
Oh wow!
All right, and if you know that it makes money, to the point almost, I want to know that. All right, I'm making $50 on everything that I sell. Right? How many products do I need to sell every day in order to cover my own expense.
Ooh, yeah, because
All right?
we're talking about decision making, right?
Decision making. I want to be able to break it down to that. I want to know that today I need 30. All right. If I don't sell 30, even if I don't know what happened, like if 30 people didn't walk through this door and I ring up 30 people,
Right.
I know that I'm under what I was supposed to be.
Yeah.
All right.
Yeah.
If more than 30, even if I didn't look at all the accounting, I know that all right, we've done all
you
right.
met your goal.
You got to be able to have it to that basic
KPI, right?
denomination, KPI,
Yeah.
right? Key performance indicators, right? You got to have it to that basic to be able to say, not complicate the matter and say, at the very least, I know that I've hit some numbers. So I think understanding those two things, you also got to understand how tax work, just so, not because it's a burden, but just so you know how to operate under it as well.
This is so good, because a lot of people have an idea to go into business, but they don't think about the back stuff, the back office stuff, right? They spend money on a nice website, spend money on a nice logo, they have a marketing plan, but they don't think about the housekeeping, the structure that's going to keep the thing from collapsing.
Yeah.
John, let's talk a little bit real quickly about cash flow versus paper profits.
Yes.
So you often hear that cash is king.
Cash is king.
Why is cash flow sometimes more important than profit on paper?
Yeah. And that was the other thing I was going to mention is cash. Cash is definitely king, because without cash, you may have a good service. All right. You may have a good product. All right. That you want to sell. However, you don't have the cash to grow it.
Yeah.
You don't have the cash to get it to market. Right. So that's how sometimes, and the funny thing about cash is when you have enough cash, everyone wants to let you have more cash.
Right. So cash attracts cash.
The bank wants to let you borrow cash when you don't need cash. All right. But when you get to a point you really need the money and you need the cash, at that point, everybody says, well, I don't know if you can repay me back. Wow. All right, I don't know if you can pay me back. So now you've got it. So that's why it's cash. One of the things at the beginning for an entrepreneur to do is to really be able to figure out their cash need, and be able to say, and expand that out for months to be able to say, all right, will I have enough cash? Because you might have a good thing that people can buy. You make a good profit out of it. You make a good margin out of it. It's serving a need in the community, or the product is one that solves someone's problem and it's out there in the community. But you can't make enough because you don't have enough cash to invest into creating that same product to do it. All right. Or you don't have enough cash to pay for the rent for the building that you're in for months.
So give me a scenario. What is the ideal percentage of cash flow versus on paper profit? So let's say this podcast is designed for entrepreneurs who are on their way to making their first $1 million or above, right? So we're not talking about the person who's just, meandering. So what is a good cash flow example? Let's say I'm running a business.
Yeah.
How much money should I have available?
So we go back to just like basic reserves, right? We want to have reserves that's at least 3 to 6 months.
3 to 6 months of what? Your overhead?
Of overhead, your operating expenses. You want to have 3 to 6 months. So that way you have that in the bank.
Okay,
right?
so
now,
if my overhead is $10,000 a month, rent, electricity,
Yeah.
Are you saying my cash flow or my reserve should be?
You need to have
40 to 60
$30,000
in the bank
of reserves, right? To be comfortable. Because in case something happens, just let's think about it from a very practical time frame called COVID.
Yeah.
All right. And so you got now, there's a lot of businesses went out of business simply for the fact that they didn't have cash to keep operating, right? Because everything was shut down. You don't have access to clients. You don't have access to customers. Well, the revenue is not coming in. So if revenue is not coming in, then you can't afford. Now, government helped with different loan things and grant things that help that. But, that was that was a short-term thing, that they provided. Once all that money ran out, then it's like, well, now we're back to, does this make money? And do I have enough cash?
Wow.
Right.
So I know we have a lot to talk about, and I'm definitely gonna have to have you probably do a part 2. We'll come back on.
Yes, sir.
How does you work for some big corporations?
Yeah.
How does budgeting actually work inside a large company? Is it a rigid plan, or is it something more flexible?
So budgeting in large companies always start not with numbers, right?
Not with numbers.
Not with the numbers, right? Numbers is just an afterthought, or just as a result of what we're trying to do. So we always go back to the vision, right? We always go back to what's the plan based on our 5-year plan or based on our 1-year plan. These are the things that we want to accomplish. All right. This is, so if we have like a thing that we're going on 3 years to get to a place, this is what we need to accomplish in year 1 on the way to what we're trying to do in a strategic plan for the 3 year. Right. So once we got that lined up, well, now all we're doing is putting numbers to that. Right.
So you start with vision, not with numbers.
That's where I would start. You got to have a place you're going. Again, let's go back.
Yeah, because you got to tell the numbers where to go.
GPS, right? It's like you getting in the car. You typed in. You got in the car. You going somewhere. You going on 75. I-75 somewhere, and you said nowhere about where you want to go.
Right.
Well, you're just gonna drive to nowhere, right?
Wow.
So I think having a vision about where you want to go, then I can say, all right, well, based on that, all right, I'm trying to go to Atlanta from Southwest Florida. All right, so that's where my GPS guides me. Then I know, all right, well, now it's part of my budget. All right, I know Atlanta is like 600-700 miles, and I can drive 30 miles a gallon. All right, I got to gas up a few times, right? So that's gas. All right, I might stop to eat. All right, that's budgeting, right? That's part of the budget. When I get to Atlanta, all right, I'm gonna spend $300 to get to Atlanta. Now, and I'm gonna sell 3 people and make $5,000 each. So I know that's $15,000 in revenue that I'm gonna make for selling this product that I'm gonna go to Atlanta to sell. All right.
Well, that's so good. So budgeting doesn't start with numbers.
Budgeting doesn't start with numbers. It starts with the vision of what we're trying to do, and it's just having really a narrative of, all right, what are we trying to accomplish in the year, in the 2-year, in the 3-year, in the 5-year. And then we put numbers to it.
That's so good. Listen, John, I think what you have done with our audience today is you have positioned our audience to really understand this dynamic part of the entrepreneurial journey. Would you agree to come back for another show? Because I definitely think we got to bring you back on, because I can already see the feedback we're going to get from this episode. If people want to get in touch with you to use your services or to engage you, how do they do that?
Yeah, they can reach me at on my cell phone, 239-269-7285. And the 7285 is actually Paul. So 269-PAUL.
Come on, you got your own number?
269-PAUL.
Okay.
All right, so that's easy. Or John at icfoonline.com.
Say it again.
John at icfoonline.com. All right.
Yeah, so, I mean, I would encourage you, if you are a business owner, you're already running a business, you're doing great, but your bookkeeping or your accounting or is off, contact John. If you're an entrepreneur and you're just getting started, in addition to your professional development services, make sure you engage someone with his expertise, his knowledge. We are so excited to be able to bring these conversations to you the Growth Beyond Limits podcast, because our job really is to position the entrepreneur, the business owner, to be able to make a profit and live well off of what you're doing. So for more of these show notes, go to levelupoutcomes.com, levelupoutcomes.com. If you are looking for professional development services, for coaching, consulting services, we are your one-stop shop where we can help you. And John is part of our network, so we can refer you to him, so we can make sure that you are doing things the right way and you're making money, because we want you to grow beyond limits. Thank you for joining us for the show today. We look forward to seeing you in another episode of Growth Beyond Limits podcast. Thank you for tuning into the Growth Beyond Limits podcast. To follow us for more episodes, please subscribe to our YouTube channel, Follow us on Instagram, TikTok, and all social media platforms. Also, to get downloadable PDFs, visit us at levelupoutcomes.com. Levelupoutcomes.com. Growth beyond limits. Go where you need to be.